Welcome back to B Grade Economics. This is Nate, your class leader. Let's get started. So today we're going to take another divergence from our regular streaming plan, and I'm going to go over something that I've had a conversation with several traders and investors about that I think deserves a more serious conversation about how this functions, and it's low volume as a sign of strength. Most traders or investors see low trading volume as a sign of weakness because low trading volume indicates a low interest in the asset. But here's my fundamental analysis theory. Low trading volume during a rise in price is a sign of a supply reduction at a rate that exceeds steady or declining new demand. This requires 3 points of information. We need price, volume, and supply. If volume is steady or even declining, but supply is declining more than the demand, then therefore the price will still continue to rise. This is also known as a silent bull run. Basically, nobody is paying attention and the price continues to rise. Even if people are paying attention and the price is rising, but traders are not coming in, what they're missing out on is that low volume is a sign of strength and not a sign of weakness. So our core information to review in order to have this conversation. Volume. It's measured in US dollar value, traded in a period of time. It's the unit divided at the current price times the rate of exchange. So if I trade $1 3 times, I have a volume of 3, right? A couple of equations to familiarize ourselves with. Money supply times velocity equals price yield. This is the that's M times V equals PY. That's the common unit of or common equation for calculating inflation. Now, this can have a vary on increase in money or increase in velocity or volume, traded volume, to equal the price yield, but also or decrease. But ultimately, you can do one or the other or both and still get a result. You just won't get exactly the same result based off the quantities. And so another way to express this is supply times the volume equals also a price yield, right? So if we increase supply and increase volume, we can get an upward trending price yield. If we decrease the volume and decrease the supply, we can get a downtrending price yield. And we can play with this equation how we want. But basically, they just have to cause an equilibrium for price. Also, obviously, I put this chart here just for simplicity's sake. Supply times demand equals the price, right? You reach a strike price between the supply versus the demand, the bid and the ask spread to come to a point of conclusion between a group of people and a group of assets to equal a price. So we have M equals money, S equals supply, V is volume or velocity in this case, and P is price or PY is price yield. So what I would argue is that price is a lagging indicator of supply. We go from extreme undervaluation to extreme overvaluation. And so if we make supply 0, meaning that let's say it's something like mining, supply is constantly moving up and down, and we have both liquid and illiquid supply. A liquid supply would be a miner that pulled a metal out of the ground, sent it to a refiner, and the refiner is ready to sell it, right? That would be a liquid supply. A piece of gold stuck inside of a vault that's at the bottom of the ocean is a very illiquid supply, right? So let's say we account for supply at all times being a steady trend, as in a single straight line, it's at 0. Then we will see that the price fluctuates both over and under value of the supply because market speculators come in and bid the price both ways up and down based off of what they think it should do. And because there's obscurity into the image of supply, we therefore make assumptions about it and we speculate and send the price further one direction or the other. So price is a lagging indicator of supply. Let's look at copper. This is the past 2 years of copper. Now, we all know that early last year, there was an event where the markets were moving up, metals were moving up, everything was generally trending up. We were starting to use the term everything bubble, and then a liquidity crisis occurred where everybody panicked and pulled their money out. So trading volume increased, selling pressure increased, and so the bid-ask spread opened up towards the bids. And so the sellers were winning, or the buyers were winning here and the sellers were losing because they were all working their way to try to reduce their total asset holdings. What happened? Well, we had a shutdown and we had productivity decrease. And copper is generally called Dr. Copper in the commodities world because it generally indicates consumption and production rates. What did we have happen? We found that our productivity was increasing anyways, that our demand was not going to stop, and that we were going to put more money into the system to cause more demand to increase beyond what the current expectations were. This caused a recovery to happen. But what happened in volume? The traders weren't confident in copper until approximately August or September last year. And I would argue that even though price went up, many percent and made it back to all-time highs, the traders still weren't convinced that we were going to have a recovery. So the traders were expecting the volume to pick up, and it didn't. And so if you waited for volume to reach all-time highs again, you missed out on a 100% move in price. Even after breaking all-time highs, we had a slight increase in volume, and maybe if you use that, you saw a decrease in volume again, you said, oh, people aren't interested in this trade. We had a supply crunch. Miners shut down, refiners shut down, factories shut down. But then when they opened back up, the shipping limitations, the production limitations, the globalism demand problem of different countries having different rules at the time caused the price to go up due to a lack of supply. It wasn't because of trading volume, it was because of a lack of supply. And we can see in Reuters that it even covers that the increase September-October, August through October in trading volumes really didn't rebound until people had more confidence, right? It marks the narrative that confidence came back, but the reality is that the supply and demand fundamentals were already there to prove that the price should be going back up. And so the confidence in volume is slower than, or the market is slower to respond to valuations correctly. And so price was a lagging indicator of supply because speculators weren't even in the markets as they normally were. So this caused a massive dip in the volume while we still saw price rise. We can see the same thing in lumber, where we saw the woodcutters essentially stop making it. Lumber producers stopped making different lengths of lumber. Futures contracts crashed, but then productivity suddenly returned back as we added money into the system and as the lockdown started to go away. And so what this caused was a massive run up in price, but it took months until the trading volume returned. We even saw a stagnation in September when people thought that, in September 2020, when people thought that the recovery was on the way, so the price of lumber should be going down again because supply chains would fix. So the traders basically sold off thinking that the supply chain problems would go away. They didn't. And so we saw yet again the price continue to rise and volume not reach all-time highs again. It took until we hit a selling capitulation again. So the trading volume is not a great indicator of a weak trend when supply is the problem, when actual limitations of supply are causing the raise in price. And so that's going to bring me to Bitcoin. And so why am I going to talk about Bitcoin? Well, this is the one where declining supply is a huge concern amongst traders right now. And so they're talking about, well, supply is down, supply hasn't been, or volume is down. Volume hasn't been as good since January 2021. And some of them, and I had a conversation with someone ask, why is the trading volume been on a decline since January? Well, I would argue that the price of Bitcoin spiked above all-time highs in January, and that caused the trading volume to increase dramatically, as breaking all-time highs is typically a trading trend to identify that we're under some intense momentum, and some of the lower risk traders who are looking for a short-term swing get their opportunities. What happened? Well, we went up more than another 100% while trading volume was on decline. So if the trading volume was on decline, what happened here? Well, we were seeing a supply crunch happen throughout the entire time, where more and more people were buying. And then as the velocity of trading went down, the volume of trading went down, we added new Bitcoin holders. And so as we added new Bitcoin holders, we increased the illiquid supply while still crashing the price because the trading volume had dropped faster than the illiquid supply was rising. And so then that cascaded an effect of overexuberance or overpricing, right? So we went into a period of underpricing because remember, we're still increasing a net, we are decreasing the liquid supply overall. And I'm going to prove that with some very basic information that most people who are in Bitcoin actually know they have access to this. We see first off, previously, this is not a new trend. While in theory, things brief really well, but in nature, they act differently, and human nature on Bitcoin is sometimes different. We have, you see in the previous cycle, we had spikes in volume, but overall, we had a decline from late 2015 all the way to the end of 2017, right, or the beginning of 2017, right? So we saw supply shocks, we saw selling and buying, and we exceeded all-time highs repeatedly when volume would spike and then decline. So even on volume declines, we saw a price rise. But then once people realized, oh, we broke all-time highs, or even later than breaking all-time highs because they thought it might have been a fluke or thought that it was over, they were clearly wrong. The supply was declining. And so I would argue that when the volume is up on Bitcoin, the supply is basically the volume is an incorrect indicator. The volume of trading on Bitcoin is typically wrong because the supply is no longer reducing. People are coming in and speculating now. This is now basically us adding a new population to become illiquid, increasers of the illiquid supply. And so volume is not a good indicator on Bitcoin of a supply and demand equation. It is a velocity part of the trading. And so the total number of active addresses is a metric that was used by Alden in 2017 in conjunction with the hash rate to help identify for corporate investors or institutional investors, how do I value Bitcoin? And so she used the exponential rate at which active addresses were increasing to show that there is a reason to be in Bitcoin and to help you value whether or not the active addresses were increasing or decreasing as a trend, and that would tell you whether or not people are increasing their holdings. And so this trend has continued up even past this beginning of 2021 ending chart. The total hash rate, as she utilizes the security of the Bitcoin network, which we continue to see has been on an exponential uptrend. And even after a crash due to a China ban on Bitcoin mining, we saw a recovery. So this being used as an indicator might have also helped increase why people would sell at the time, because they were using this as the hash rate as an indicator of whether or not to hold Bitcoin, and it returned all the way back to 2019 levels. And so then we get on to the Bitcoin Exchange Reserve. This is Bitcoin exchange flows from CryptoQuant. I pull this up pretty regularly to identify that historically we have this trend of where there's less than 11% of the total Bitcoin supply on exchanges. We go on a very strong rally. We have gone on rallies with much more in this cycle on exchanges than previously. So I would say that illiquid supply can also indicate that there are wallets or holders on exchanges that are also just leaving it on an exchange, and that is increasing as we increase the population into Bitcoin. So I don't necessarily use that 11% as a hard, fast number, but we are seeing a constant decline in how much Bitcoin is on the exchanges. We saw the uptrend as selling went off into April 2021, and we're now looking at a clear and obvious decline, even though people continue to say the trading volume is down. Well, the trading volume doesn't have to be high in order to reduce the supply. It just has to be consistent. And so this is Bitcoin Liveliness by from Will Clemente. He's on Twitter and he's a great follow. Glassnode's data showing how many days a Bitcoin basically sits in a wallet. And we're seeing that that is consistently increasing in terms of the amount of time that it is immobile. So it creates a time period of showing how long Bitcoin holds still. And Bitcoin becomes less immobilized when price comes up to cause it to yield. But we're seeing that we've gotten a really flat line since 2017. And we used to get these very strong peaks. People are less and less selling and less moving their Bitcoin throughout the years. So we are seeing the illiquid, the mantra of HODL is essentially carrying out into the supply chain of Bitcoin. So here's Bitcoin's illiquid supply. This is from Peter from Game of Trades, also a great follow on Twitter and YouTube. And this is showing divergence of illiquid supply. It's Bitcoin that hasn't moved in a year from price. And so we can see that everything in green is a bullish divergence, while red is a bearish divergence, meaning price goes up. Bearish divergence would be price going up, but the illiquid supply going down. But we've mostly had a divergence where the illiquid supply has gone up and the price has gone down, meaning that it's going in the wrong direction. And so while that can continue, that cannot continue forever, because eventually you run out of Bitcoin. So that would entirely violate all function of supply and demand fundamentals. This is from Jordan Lindsay, also another great follow, and an interview he did with a man named Cole, who I did not get his last name in the video, so I apologize. If anyone could provide it down below, that would be great. Conquering the markets. Jordan Lindsay and Mr. Cole cover the Bitfinex open orders, and in this we can see that there is a wall of open buy orders on Bitcoin. So people think that the price can continue to fall, and I would argue that sure, it can, absolutely. But how many people are going to be there to buy it the lower it goes? We've seen that the increase in wallets, the increase in illiquidity is just constantly ongoing, and yet the open orders are just constantly there. And they're increasing, and as you go lower, it gets super dense, and under 42K, there is a wall of a lot of money waiting to buy at under 42K. And so I would propose that we're not going to go back to that price. We will never see that price again because of how many people are there waiting to buy. And our only problem right now is that because of the confidence in this supply and demand problem, there's a lot of leverage traders at the top causing distribution events. But these distribution events are in divergence to the illiquid supply. And so if we look again, making supply a straight line, and we were to normalize supply on an exponential growth graph, Bitcoin is weaving around that supply trend. And I would argue that the volume is a bad indicator of whether or not Bitcoin is in low supply. Price can go down from here, but we're at a point where going down is the wrong direction to what is happening. And so I think if you're short Bitcoin, it's just illogical. The evidence is very clear that we're trending in a way where there is no choice but the price to go up, or everybody's just going to sell because they don't believe in it anymore, which is completely valid, except for 10 years they've been able to withstand 80% volatility, 80% drops from peaks. So what tells you what's going to happen first? Are the illiquid suddenly going to become liquid because the price drops another 10%, another 20%? Or are we just going to increase buying? Is the volume going to spike into the selling? But when there's a seller, there's always a buyer. So somebody buys that Bitcoin if it drops any lower. I would argue that the low volume is a bad indicator to stop looking at low volume during a supply crunch. Thanks for watching. This is Nate with B Grade Economics. Follow me on Twitter and YouTube for our trade from 1,000 to 1 million. We completed our first trade at 100% gain. We're currently sitting at 150% gain from a couple of other failed 100% gains. And so we're looking for our next 2x from 2,000 to 4,000. So wish us luck, and I'll see you next time.